On August 15th, 1971, a Sunday evening broadcast changed everything about money. The President of the United States appeared on television screens across America and announced a decision that would quietly transfer power from physical metal to printed promises. Within hours, the global financial system began operating under rules that had never existed in human history. But here's what almost nobody tells you. This wasn't a sudden decision. It was the final collapse of a system that had been breaking for decades. And the question we need to answer is, why did it break? Who benefited? And what did we lose when gold stopped being money? Stay with me, because by the end of this story, you'll understand why your paycheck buys less every year, why governments can spend trillions they don't have, and why we might be living through the early stages of this system's next breaking point. To understand what died in 1971, we need to go back to 1944. World War II is ending. The global economy is in ruins. Representatives from 44 nations gather at a hotel in Bretton Woods, New Hampshire, with one goal: create a new monetary system for the post-war world. Here's what they decided. Gold would remain the foundation of money, but with a twist. Only one currency, the US dollar, would be directly convertible to gold at a fixed rate of $35 per ounce. Every other currency would peg itself to the dollar. The United States, holding the largest gold reserves in history, essentially became the world's central bank. This was the Bretton Woods system. It promised stability, predictability, and discipline. If a country printed too much money, it would lose gold. If it ran persistent deficits, gold would flow out. The system had a built-in punishment mechanism for bad behavior. But there was a hidden flaw, a time bomb that would take 27 years to explode. The flaw was mathematical. As global trade expanded, the world needed more dollars to facilitate transactions. But under Bretton Woods, every dollar was supposed to be backed by gold sitting in Fort Knox. The more dollars America printed, the thinner the gold backing became. This created an impossible dilemma, later called the Triffin Paradox, after the economist who predicted it. To supply the world with dollars, America had to run deficits. But running deficits meant printing more dollars than it had gold to back them. Eventually, foreign governments would realize the emperor had no clothes. Through the 1950s and early 1960s, this worked. American gold reserves were enormous. The dollar's credibility seemed unshakable. But then came Vietnam, and the Great Society programs. In the space race, the US government was spending massively on multiple fronts simultaneously. The gold was leaving Fort Knox faster than anyone publicly admitted. By 1965, foreign central banks began to notice something disturbing. They were holding mountains of US dollars, but the ratio of dollars to actual gold in American vaults was becoming dangerous. France, led by President Charles de Gaulle, decided to test the system. They started converting their dollar reserves into gold. Other countries watched nervously. If everyone did what France was doing, America would run out of gold in months. The entire system would collapse. The US tried to hold the line. They created something called the London Gold Pool, a consortium of central banks that would sell gold to keep the market price at $35 per ounce. They pressured allies not to convert dollars. They implemented capital controls to stop gold from leaving. But these were band-aids on a hemorrhage. By 1968, the London Gold Pool collapsed. Gold trading split into two tiers: an official price for governments and a floating market price that was rising fast. U.S. gold reserves had fallen from over 20,000 tons in 1950 to under 10,000 tons by 1971. The Nixon administration faced a choice: dramatically cut spending, raise interest rates, accept a painful recession, and defend the gold standard, or break the promise. That Sunday night in August 1971, Richard Nixon chose to break the promise. In a 15-minute address, he announced the U.S. would temporarily suspend the convertibility of dollars into gold. He called it protecting America from speculators. He promised it would strengthen the dollar. It was a lie wrapped in necessity. The suspension was never temporary. Within 2 years, the Bretton Woods system was officially dead. By 1973, all major currencies were floating, no longer anchored to gold or anything else. For the first time in history, the entire global economy operated on pure fiat currency, money backed by nothing but government decree and public confidence. The implications were staggering. Governments could now print money without immediate constraint. Deficits no longer required painful choices. Debt could expand infinitely as long as confidence held. And expand it did. What happened next reveals everything. In the 1970s, inflation ravaged the developed world. Oil prices quadrupled. The dollar lost a third of its purchasing power in a decade. Workers' wages, once steadily rising in real terms, stagnated. The gap between productivity gains and wage growth began widening, a trend that continues today. But governments loved the new system. U.S. federal debt, which had been around $400 billion in 1971, is now over $34 trillion. Japan's debt-to-GDP ratio exceeds 250%. The European Central Bank creates money by pressing buttons. Meanwhile, gold, the metal that was supposedly obsolete, has risen from $35 an ounce to over $2,000 today. A 57-fold increase. The market's verdict is clear. The shift from gold to debt did something else profound. It changed who holds power in the economy. Under the gold standard, creditors had leverage. Governments couldn't inflate away obligations. Now, debtors, especially government debtors, hold the advantage. Borrow today, repay with depreciated money later. This restructured society in ways we're still discovering. Look around today and you'll see the same patterns accelerating. The U.S. Federal Reserve's balance sheet has exploded from under $1 trillion before 2008 to over $7 trillion today. Global debt now exceeds $300 trillion, 3.5 times global GDP. Central banks are trapped. Raise interest rates too high and governments can't service their debt. Keep rates too low and inflation destroys savings. We're also seeing the same warning signs that preceded 1971. Faith in the dollar is eroding. BRICS nations are discussing alternatives. Central banks are buying gold at the fastest pace in decades. China and Russia have been accumulating thousands of tons. History doesn't repeat, but it rhymes. The difference is we're now 50 years deeper into an experiment with money backed by nothing. The debt levels are exponentially higher. The political will to accept pain is weaker. And the next breaking point, when it comes, won't have gold to fall back on because we already abandoned that anchor. So here are your 3 takeaways. First, the 1971 decision wasn't about economics alone, it was about power. The ability to print money without constraint is the ability to allocate resources without consent. Second, every fiat currency in history has eventually failed. The average lifespan is 27 years. We're now at 54 years and counting. Third, the system's next evolution is already beginning. Whether it's digital currencies, a return to commodity backing, or something entirely new, change is coming. The real question is whether it happens through controlled reform or catastrophic collapse. Think about this. We're living through one of the longest monetary experiments in human history. We have no idea how it ends, but we do know that when confidence breaks, it breaks fast. And unlike 1971, there's no backup system waiting. If this story changed how you think about money, hit subscribe. Next week, we're examining what happens when a currency actually dies, and why it's happening more often than you think. The patterns are unmistakable once you learn to see them.